It's been a bullish few months for the markets, huh? All of the indices in solid positive territory. But the bulls out there might not want to get too comfortable. Is it time for investors to beware the bear? Keith Springer is the president of Springer Financial Advisors. He is a long-term bear, which has not been a good thing to be, Keith.
Well, I've been a short-term bull mark, and I'm very bullish. I think we have a Goldilocks scenario. We have a lot of stimulus coming in. I think things look very good right now. The market, you can't argue. The fundamentals look good. The technicals look very good. You got a lot of money coming in from the Fed. Short-term things look good. The problem, Mark, is...
Okay, well, stop. Define short-term.
6 months, 3 to 6 months. We've got to remember the market looks out.
All right. Okay, so what nasty things are going to happen come spring?
What happens is the market is reliant on continued easing. It's counting on not only QE2 continuing, but QE3 and QE4. As long as the Fed, as long as Bernanke can continue to throw money at this market, the market will continue to do well. The problem is, at some point, they're going to have to stop. We've been very lucky that the euro is in worse shape than the dollar. Otherwise, we might see more bond vigilantes come in or more pressure or stress. But right now, things look very good. We've got good earnings, we've got good fundamentals, and we've got a lot of money coming in. Beware, Mark, when the money stops coming in from the Fed, because that's when things are going to slow down, and that could be 6, 8, 10 months from now. And when it drops, it could be very dangerous. I think we're in a bubble.
So you're a financial advisor. What are you telling your clients right now? Given your scenario, Keith, what are you telling them to do?
Well, we're investing basically for this market, looking for the niche, looking for where that equilibrium is. We're big investors in income and dividends, big believer in dividends. You've got to pay yourself first. Income and dividend type investments do better in flat to down markets. They still do well in up markets. I love some of the MLPs like Legacy. I'm still buying some of the commodities like gold and silver. I particularly like silver wheaten because they're a very low-cost producer. Emerging markets, I like ECON, which takes advantage of the middle consumer in the emerging markets, not so much in the large businesses of like EWF is mostly oil, Petrobras and such. But you've got to be careful. You've got to have an exit strategy. You can take advantage of where we are now, but still be wary.
What would be your exit strategy for commodities? They're having an amazing run, and I see that you still find them attractive, but at some stage things can end badly for commodities.
Well,
what is your exit strategy there?
Commodities in particular, Mandy, I like gold and silver as a third currency, not basically for inflation, but as a third currency because it's going to give you some protection against a lower dollar, a lower euro, and that's why people will buy commodities, particularly gold and silver. We've got to remember, Bernanke has thrown money at this market looking for a lower dollar, which does what? It rises commodity prices, and it just is going to continue to do that. The longer he puts money into this market, commodity prices will rise. We've got to remember the people who are printing the money, the guys who have the money, are telling you to put money in this market. They're looking for the wealth effect. And they're saying, buy stocks. And it's actually working. People are feeling a little bit better. But in a bubble, we all know how bubbles, what happens in bubbles. We know what happens. They burst. So you've got to have an exit strategy.
All right, Keith, thank you very much.
Thank you, Mark. Thank you, Manny.
Time for us to use our exit strategy here. We're out of time.